You could wake up every day to the sound of dividends hitting your account instead of the jingle of coins in your pocket. Envision a world in which being financially independent is more than a pipe dream. It's not an unattainable pipe dream to think this way. There are innumerable possible financial outcomes to think about, just as the concept of a comfortable retirement varies from person to person to person. Reverse mortgages, downsizing, and relocation to more affordable areas are options that some people may consider. However, dividends from investments are a viable option that is generally disregarded, something that can increase your monthly income by $2,900. Listen up, because we're about to dish on 3 lightning-fast routes to your secret sauce objective. What exactly is the magic formula for figuring out how much money you should put into an investment? It all boils down to priorities and budgetary constraints. The typical male annual expenditure is roughly $67,000, but it may not be a useful yardstick for you. Your needs, goals, and level of ease can all be accommodated. Let's spice up the photo with a little mystery. This is the kind of life where you may reap the rewards of your hard work without ever having to dip into your principal, since your investments are generating a steady stream of income. It's like having a hidden money tree that continually produces passive income for you. It's tempting to consider the possibilities. Keep in mind that the purpose of this trip is to locate a middle ground where your goals and aspirations coincide. To make dividends your ticket to financial freedom, first picture the life you want to live, and then let the numbers lead the way. In this video, I'll explain to you and Mark exactly what you need to do to earn $2,900 per month or $35,000 per year. Let's go through what a dividend is and how it works, as was previously explained. Imagine you own a portion of a publicly traded company's stock. When the company generates a profit, it can decide whether to reinvest in the business or distribute the proceeds to its stockholders. The owners of a corporation are the shareholders, such as Mark. If the company decides to pay out a percentage of its profits to its shareholders, it will pay out dividends. Payouts of dividends can take the form of cash via direct deposit or check, or additional shares of the company's stock, and companies have varying schedules for doing so, though many do so quarterly. Now, let's talk about dividend yield, which is a metric for determining how much money you're making from dividends relative to the price of the stock. Mark may better assess the value of his investment in dividend, paying stocks by using dividend yield to make price comparisons and inform his investment decisions based on his goals and tolerance for risk. Mark has the potential to earn regular income without having to sell his shares, which means he can enjoy a steady stream of money while still keeping his investment intact, which is pretty fantastic. So for Mark and anyone else interested in earning passive income, dividends can be a compelling strategy to consider. They provide a way to grow your wealth over time and live off the income generated by your investments. Covered call exchange, traded funds, ETFs, rank first because they provide investors with the ability to profit from both stock appreciation and dividend payouts. The key to its success is how. The ETF buys stocks and then uses the premium it receives from selling call options on those stocks to distribute dividends to its shareholders. Call options give the buyer the right but not the obligation to buy a stock at a specific price within a certain time frame. Moreover, there are a number of popular covered call ETFs to examine, such as SBLK and Use, which may realize capital gains if the stock price increases over the call options, strike price, and the underlying equities are sold. Let's take a look at the trailing 12-month yields of these funds, which are typically double the yields of many standard dividend equities. The dividend yield for XLIDE is 11.83%. The yield on oil is 11.82%, and on Use it is 11.81%. These exchange-traded funds, ETFs, are attractive because they can generate passive income in the form of dividends as well as option premiums, so resulting in a more steady and consistent stream of income over time. However, it is important to be aware that these ETFs are not without their hazards, including the possibility of losing money if the underlying investments perform poorly. Now, let's apply this theory to Mark Adventure and see if we can improve his chances of success before his options expire or his stock price drops. If Mark wants to make $2,900 per month or $35,000 per year through covered call ETFs, we can adjust the numbers so that he invests between $280,000 and $310,000 and $310,000. This is a very attractive return on investment, especially when compared to the $2 million you would need to invest in traditional dividend stocks to generate the same return. Earning $35 SCHD or $2,900 SMO is within Mark's reach without draining his savings or requiring him to take on undue risk. Mark can pursue his goals of living off dividends and achieving financial independence by using covered call ETFs, which present a potential to earn a regular income stream with minimal capital necessary. Mark can make an additional $35,000 per year or $2,900 per month by investing in dividend stocks. The second high-yield option is to invest in what are known as real estate investment trusts, REITs. Mark should look into real estate investment trusts, REITs, which are like teams that invest in real estate properties like malls, offices, and apartments, and then share some of the profits they make with their investors in the form of dividend. One excellent REIT to consider is Two Harbors Investment Corporation, which has a dividend yield of 20.3%. Two REITs with a proven track record of providing investors with a stable income stream via dividends are Brandywine Realty Trust, 19.9% dividend yield, and Orchid Island Capital Incorporated, 19.4% dividend yield. Investment in real estate investment trusts, REITs, has historically shown solid performance with an average annual return of 10.8% over the past 20 years, suggesting that REITs may be a good way for Mark to potentially grow his wealth and earn a steady income. However, the amount of money you get from REITs can fluctuate depending on the number of people renting the properties and the state of the economy. A good way for Mark to retire with REITs is to save and invest a certain amount of money every week and let the dividends add up until he reaches his goal. If he expects to get around 10.8% per year, he would need to invest about $320,000. However, this number can change depending on whether he chooses to put his money in different REITs or just one. In 5 to 7 years, if he is dedicated and patient, he can achieve financial independence. Investing Mark needs a strategy for dividends. Knowing how much money he needs and what he wants to accomplish will guide him in selecting the most suitable real estate investment trusts, REITs, for his portfolio and keeping him on track long term. Mark may find that he can get by just well on less than $35,000 a year, but he may need more than that to support his family and ideal way of life. Unlike common stocks, real estate investment trusts, REITs, typically pay dividends on a monthly basis, making them an appealing option for those seeking a steady income from the stock market. If Mark adopts the strategy of investing in REITs, he can realize his financial goals of earning $35,000 per year or $29,000 per month from dividends. If Mark is ready to take the next step towards financial independence and realize his goal of supporting himself only through dividends, he should investigate real estate investment trusts, REIT. Number 3. Dividend Aristocrats. Dividend for aristocrats? These stocks, known as aristocrats, are part of a select group of companies in the S&P 500 index, known as hawks for their remarkable track record of increasing dividend payments to shareholders for at least 25 years in a row. While their dividend yields are smaller than those of covered call ETFs and real estate investment trusts, REITs, companies like Threem, Leggett & Platt, and Walgreens Boots Alliance are among the most reliable in terms of paying out their dividends to shareholders. Dividend. To qualify as a dividend aristocrat, a company must have increased its dividend payout for at least 25 consecutive years. Whether or not it is a good idea to invest in the stocks that make up the dividend aristocrats depends on the investor's time horizon, risk tolerance, and specific investment objectives. Even though aristocrats can be found in a wide variety of fields, they all have a few things in common. How much money would Mark need to invest at a 7th dividend yield to achieve his goal of $29,000 per month, assuming he invests in dividend, growing, growth-oriented companies? These companies have a track record of increasing their dividend payments over time, so they are less likely to be acquired by smaller competitors. Mark must invest $500,000 to achieve financial independence. This sum may seem large when compared to the $2 million required to purchase a standard dividend stock. Mark would be well to diversify his dividend investments over numerous companies, each of which would pay out a smaller percentage of the total. Risk-averse aristocrats put their money into dividend-paying stocks. Mark could receive consistent payments from his investments because they are blue-chip companies with a history of dividend growth and because they're included in the S&P 500 index, which lends credibility to their performance. Learn how to achieve your dividend income objectives quickly and easily by investing in the top 7 dividend ETFs every month.